Something happened this week, and before I explain it, I want you to sit with it for a moment. In just 48 hours, more than 6 trillion in market value was erased. Not slowly, not over the course of several weeks, in 48 hours. The S&P 500 dropped 10%. The Nasdaq fell into bear market territory. The VIX, the index that measures how much fear is being priced into the market, surged to 45. The last time it reached that level was in March 2020, when the world had no idea how severe COVID was about to become. Oil collapsed. Copper collapsed. And gold, the asset that every financial advisor, every macro analyst, and every central bank in the world has spent years describing as the ultimate safe haven in moments exactly like this, gold fell too. Everything dropped at the same time. During a trade war that economists everywhere insist should be inflationary. Now here is the question I want you to keep in your mind for the next 20 minutes. If tariffs create inflation, and inflation has historically been supportive for hard assets like gold and commodities, then why did everything crash together? Why did the very assets that are supposed to protect you in this kind of environment fail to protect you in this kind of environment? The answer is not the one you have been hearing on financial TV. And once you understand it, it will change the way you interpret every major market event for the rest of this year, and possibly for the rest of this decade. I have spent my career studying economic systems, not individual stocks, not quarterly earnings, systems, the patterns that repeat over decades because human nature does not change, debt cycles do not change, and the mechanical link between policy decisions and asset prices does not change. What I am watching right now is not new. The trigger is new, but the transmission chain is 50 years old. And when you understand that transmission chain, you stop reacting to daily noise and start positioning yourself for the outcome the structural forces are pointing toward. So let me start at the beginning. On April 2nd of this year, the United States announced what it described as a universal tariff on all imports. A 10% baseline duty was applied to every country at the same time, with higher reciprocal rates imposed on roughly 90 nations. The stated objective was simple enough: protect American manufacturing, bring jobs back home, generate federal revenue, and correct what the administration described as decades of unfair trade practices. The market's immediate response was a sell-off. The very next day, China responded with a 34% retaliatory tariff on American goods. The sell-off intensified. Within 2 trading sessions, the numbers I mentioned at the start of this video had become reality. Now, the conventional explanation sounds like this. Markets do not like uncertainty. Tariffs create uncertainty, therefore markets sold off. That explanation is not wrong, but it is about as useful as telling someone whose house is flooding that water is wet. It describes the surface, it does not explain the mechanism, and without understanding the mechanism, you cannot know how deep this goes, how long it lasts, or what you are supposed to do about it. So let me give you the mechanism. A tariff is a tax. That is not a political statement. It is simply a definition. When a government places a tariff on an imported good, somebody has to pay that cost. And the question of who pays it is the single most important economic question in this entire situation. The answer is not the one most people repeat. The common assumption is that foreign exporters absorb the tariff, that the Chinese manufacturer or the German automaker simply accepts a smaller profit margin in order to preserve access to the American market. But data from every major tariff episode in recent history, including the 2018 and 2019 China tariffs during Trump's first administration, shows that this is not what usually happens. Independent analysis from the Congressional Budget Office and multiple regional Federal Reserve banks consistently finds that foreign exporters absorb only about 4 to 10% of the tariff cost. The remaining 90 to 96% is passed through to American importers, the U.S. companies buying those products, and then passed on again to American consumers through higher prices. That means the tariff functions as a broad-based consumption tax on the American economy. Every dollar raised through tariff revenue is a dollar pulled out of the disposable income of American households and out of the operating margins of American businesses. Consumer spending power declines. Corporate earnings expectations decline. And because the stock market is ultimately a claim on future corporate earnings, a present value calculation of the cash flows companies are expected to generate for shareholders, when earnings expectations fall, stock prices follow. That is not fear, that is arithmetic. But this is where the situation becomes much more complicated and much more dangerous. Tariffs are also inflationary. When import costs rise across the entire economy at the same time, the overall price level rises with them. This is not theoretical. Jerome Powell said it directly at the most recent Federal Open Market Committee meeting, noting that elevated consumer prices largely reflect, in his words, inflation in the goods sector that has been boosted by the effects of tariffs. He said it twice at 2 consecutive meetings. The Federal Reserve's own inflation forecast for 2026 was revised upward. Its GDP growth forecast was revised downward. The central bank is now looking at an economy where prices are rising while growth is slowing at the same time. That condition has a name. It is called stagflation. And stagflation is the one macroeconomic environment where the Federal Reserve's primary tool, interest rate policy, becomes genuinely weak. Think about the bind that creates. If the Fed cuts rates to stimulate a slowing economy, it risks worsening inflation, because cheaper credit in an already inflationary environment pours more fuel onto the fire. If it raises rates to bring inflation under control, it risks deepening the slowdown, because higher borrowing costs suppress investment, housing, and consumption at the exact moment those areas are already being squeezed by tariffs. The Fed cannot move in either direction without making one side of the problem materially worse, so it does what it has been doing. It pauses, it waits. It says uncertainty is remarkably high, which it is, and then it does nothing. Now here is the part most people are missing completely. For roughly 15 years, from 2008 through about 2022, markets operated under one powerful assumption. The assumption was that whenever markets suffered a serious decline, the Federal Reserve would step in. It would cut rates. It would expand its balance sheet. It would inject liquidity. This happened so consistently and so predictably that traders gave it a name. They called it the Fed put, the idea that the central bank was effectively providing insurance against catastrophic market losses. Buy the dip because the Fed will always rescue the market. That assumption is now being seriously challenged, not because the Fed does not want to help, but because the inflationary pressure created by tariffs has taken away the policy room the Fed would need in order to intervene the way it used to. When inflation is already above target and tariffs are actively pushing it even higher, cutting rates is no longer a clean response to a market decline. The insurance policy that markets have been priced around for the last 15 years has become conditional. And when the market begins to realize that the insurance it has counted on may not actually pay out, the repricing is not slow. It is sudden. It is violent. It is exactly the kind of repricing we saw this week. But there is still another layer to this. And this is the layer that explains why gold fell along with everything else, which I know is the specific question many of you came here to understand. Over the last 2 years, as gold climbed from roughly $2,000 an ounce to its January 2026 high of $5,595, retail investors poured money into the gold market in a very specific way. According to available data, about $70 billion flowed into gold exchange-traded products between 2025 and early 2026. And a meaningful share of that capital did not go into simple gold exposure. It went into leveraged gold products, instruments designed to deliver 2 or 3 times the daily return of the gold price. Those products require daily rebalancing. When the price of gold falls, a leveraged product has to sell gold futures in order to maintain its leverage ratio. That selling pushes the gold price down even further. That additional decline triggers margin calls on other leveraged positions across the portfolio. And those margin calls force funds to liquidate whatever they can sell quickly, which includes not only gold but equities, oil futures, copper, and every other liquid asset they hold. This is forced selling, and the defining feature of forced selling is that it has no respect whatsoever for fundamental value. When a fund gets hit with a margin call, it does not pause to ask whether gold is undervalued. It does not stop to consider whether oil may recover. It sells whatever it can, at whatever price the market will take, because it has no choice. That mechanical chain reaction, leverage building on the way up and forced liquidation on the way down, is why everything fell at the same time. It was not a collective decision that gold had become worthless or that oil had no future. It was a liquidity event, a fire sale driven by the mathematics of leverage, not by any serious reassessment of intrinsic value. And here is the historical parallel I find most useful for understanding where this can lead. In 1929, the United States economy was operating with historically elevated valuations, a labor market that appeared strong, and a policy environment that felt stable. The Smoot-Hawley Tariff Act, which raised import duties to the highest levels in American history, was passed in 1930, not at the beginning of the crash, but in the middle of it. The tariff was supposed to protect domestic industry and reduce unemployment. Instead, trading partners retaliated immediately. Global trade volume fell by roughly 65% between 1929 and 1934. Corporate earnings collapsed. Unemployment rose to 25%. What began as a financial crisis became a generational economic depression, made dramatically worse by the very trade policy that was supposed to contain it. I am not predicting a repeat of the 1930s. The policy tools available today are far more advanced, and the global financial system has circuit breakers that did not exist back then. But the mechanism is the same. Tariffs raise costs. Trading partners retaliate. Global demand contracts. Corporate earnings decline. The Federal Reserve's room to respond narrows, and the economy drifts into a period of stagnation that is much harder to escape than a normal recession, because the inflationary component prevents the kind of aggressive monetary easing that usually ends recessions quickly. There is also a more immediate parallel that deserves your attention. Last year, when the first round of broad tariffs was announced on what the administration called Liberation Day, the S&P 500 lost about 10% in 2 sessions, almost exactly what we saw this week. At that time, the administration paused some tariffs, granted exemptions, and the market partially recovered. Some traders interpreted that as confirmation of what Wall Street started calling taco, the idea that the administration always backs down before the economic pain becomes too severe. Maybe that pattern is real, maybe it is not. But the problem with building an investment strategy around a psychological guess about one decision-maker's tolerance for pain is that you are no longer analyzing economics. You are trying to predict behavior. And behavior is far less reliable than mechanism. I would strongly encourage you to focus on what the structural forces are doing, not on what you think a particular individual may or may not do under pressure. And the structural forces right now are these. Tariffs are inflationary, the Fed is constrained, corporate earnings are being compressed, leverage is unwinding, and global trade is contracting at the margin. Those forces do not change because of a tweet. They do not reverse because of a press conference. Now let me turn to what the second-order and third-order effects of this environment are likely to look like over the next 12 to 18 months, because this is where I think a lot of commentary is genuinely failing investors. The first second-order effect is supply chain repricing. global supply chains were built over decades around a very specific set of assumptions. Assumptions that certain inputs would cost a certain amount because they came from certain countries under certain trade agreements. Those assumptions have now been disrupted all at once and across the board. Companies cannot rebuild supply chains in a matter of weeks. They will try to do it over the course of years. And during that transition period, input costs stay elevated for businesses that cannot quickly find alternative sources. Production efficiency falls as supply chains are restructured under new constraints. And the inflation created by tariffs does not fade quickly, because the disruption to the supply chain reinforces the direct price effect of the tariffs themselves. This is why economists at Morningstar and elsewhere are forecasting that the inflationary impact of the current tariff regime will last far longer than the initial shock, which means the Fed's constraint is not just temporary, it could remain in place for 2 to 3 years. The second-order effect is what happens to the dollar. This requires careful thinking because the dollar's short-term path and its medium-term path are pointing in opposite directions, and confusing the two is a serious analytical mistake. In the near term, during periods of intense market stress, global capital tends to rush into U.S. dollar assets, especially U.S. Treasury bonds, because they remain the world's most liquid safe haven. That supports the dollar in the short run, even while U.S. markets are falling. We saw that dynamic clearly during the early phase of this week's sell-off, but over the medium term, a more complicated and potentially more important dynamic begins to emerge. When the United States imposes sweeping tariffs unilaterally, disrupts long-standing trade relationships without warning, and openly uses market instability as a negotiating tool, as this administration has done, it sends a signal to the world that American economic policy is less predictable than it used to be. And predictability is the foundation of reserve currency status. That status is not protected by law. It is not guaranteed by military strength. It is earned continuously through the reliability of the rules-based system that makes U.S. assets worth owning. When that reliability begins to be questioned, even at the margin, the dollar's reserve premium begins to erode at the margin too. Not overnight, not all at once, but gradually and in a way that compounds over years. The third second-order effect is the one that matters most directly to anyone watching this who has savings, a retirement account, or any concern at all about purchasing power over the next decade. When governments pursue policies that simultaneously weaken growth and preserve inflation, when they create the conditions for stagflation, the historical response has been remarkably consistent. Eventually, the monetary authority prints money, not because it wants to, because it has to. The political economy of prolonged stagnation, high unemployment, and rising prices is unsustainable. The pressure on policymakers to do something becomes overwhelming, and the thing central banks know how to do is inject liquidity and reduce borrowing costs. The exact timing of that response is uncertain, the scale of it is uncertain, but the direction of the consequence is not uncertain at all. More money in the system, lower real returns on financial assets, higher nominal prices for everything that cannot be printed, including gold, including real assets, including hard commodities. This is the critical distinction between what is happening to gold right now and what the structural forces are pointing toward for gold over the medium term. What is happening right now is a mechanical liquidity event driven by forced selling. What the structural forces are pointing toward is something entirely different. Forced selling is temporary by definition. It ends when the leverage is cleared. But the structural case for gold, fiscal excess, monetary accommodation, dollar erosion, central bank diversification, is not temporary. It is the product of decades of debt accumulation and policy decisions that cannot be reversed quickly or painlessly. The paper market is sending one message: fear, liquidation, stress. The physical market, where central banks, Asian sovereign buyers, and long-horizon institutions are accumulating at lower prices is sending a very different message. Let me be very specific about what I think all of this means for how you should be thinking right now. The first thing I would urge you to understand is the difference between an asset falling because its fundamental value has changed and an asset falling because leveraged participants are being forced out of their positions. Those are not the same thing. A house worth $500,000 is still worth $500,000 during a week when the seller desperately needs cash and accepts $400,000. The price changed. The value did not. What you should be watching is whether the fundamental conditions that determine long-term value have changed. And for gold, for hard assets more broadly, for the real economy's ability to preserve purchasing power, those conditions did not improve this week. If anything, they got worse from a structural perspective. The second thing I would urge you to watch is the Federal Reserve's next true move. Not the next meeting, not the next statement. The next real change in direction. Because when the Fed is eventually forced to pivot, when unemployment rises enough or growth contracts enough that the political pressure to ease finally overcomes the inflation constraint, the reversal of all three headwinds that are currently weighing on gold will happen at once. The dollar will weaken. Real yields will fall. The liquidity that forced sellers pulled out of the market will come back. Historically, these reversals have been fast, and they have been powerful. The investors who are positioned before that pivot capture most of the move. The investors who wait for confirmation that the pivot has already happened usually enter after much of the recovery is already behind them. The third thing I would offer is probably the most important and also the hardest to act on, because it requires you to resist extremely strong psychological pressure. The worst investment decisions are made at moments of maximum apparent clarity, moments when the dominant narrative is so strong, so widely repeated, so relentlessly reinforced by every news source and every conversation around you that going against it feels reckless. Right now, the dominant narrative says markets are collapsing, trade wars are spiraling out of control, recession is unavoidable, and the safest thing to do is reduce risk and wait for certainty. That narrative contains enough truth to feel believable, but it is incomplete in one very important way. It treats the current phase of the cycle as though it is the final phase. It is not. The debt cycle does not end with a trade war sell-off. The structural forces driving monetary expansion, dollar erosion, and the long-term case for hard assets are not resolved by 2 ugly weeks in April. They are intensified by them. The system is under stress, and stress, properly understood, is not chaos. It is the process through which overvalued assets find their true price, over-leveraged positions get flushed out, and the structural demand for genuinely scarce assets eventually reasserts itself. Understanding that mechanism, truly understanding it rather than just hearing the words, is the difference between being reactive and being prepared. It is the difference between watching a $6 trillion wipeout and actually understanding what that wipeout means for the next 3 years. I have watched multiple cycles unfold over the course of my career. The pattern I am describing is not new. The transmission chain from policy disruption to market stress to eventual monetary accommodation to hard asset outperformance has repeated itself with remarkable consistency across very different historical settings. What changes is the trigger. What changes is the timeline. What does not change is the underlying logic of how debt cycles resolve, how fiat currencies behave under fiscal strain, and how markets reprice when the assumptions they were built on are suddenly challenged. Pay attention to the mechanism. Tomorrow's headlines will be different. The mechanism will not.